CF Benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Welcome back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. With me, as always, I've got Mark Pilipczuk, our research analyst, and Tomas Perfumo, the chief economist for Kraken. And joining us this week, we've got Ishmael Asad, research analyst from Bitwise, and our very own CEO, Chung. I'm going to just quickly read off a housekeeping item that, a disclaimer here that this discussion is for informational and educational purposes only and should not be considered investment advice. Nothing we discuss today constitutes a recommendation to buy, sell, or hold any asset or token. Always do your own research and consult a qualified financial advisor for making investment decisions. Ish, I want to just open the floor with you since you're our external guest of honor here today. Why don't you just give yourself a brief introduction to the audience here so we can all get to know you.
Morning. Thanks so much for having me on. It's a pleasure to be here. Lots to talk about. I'm a research analyst on the research team at Bitwise. Joined Bitwise last year, focused on covering crypto markets more broadly. But happy to be here today.
Awesome. Yes, we are. Bitwise, of course, does not need any introduction. We just had Ryan Rasmussen on, I think, a few weeks ago, and you all are very, very close partners with us, and we all enjoy working together. So excited to have you on. Isha, also, are you based in NYC, and can you give us a quick rundown of how the city is today? Is everybody just super ecstatic about the game last night?
Yes, I am based in NYC, and yes, that is the case. Last night was crazy. You walk down the street and you'll see hordes of people posted on street corners just watching the Knicks game on just the projector they set up or like looking through the window of a restaurant.
That was crazy. Yeah, I was following my social media accounts, and I just kept seeing all these watch parties that my friends were at. It was incredible. They were projecting it on buildings. You could see it down in the Bowery or in Brooklyn. All these watch parties across the city. So pretty exciting stuff. Go Knicks. Let's see if they can actually get the job done here. So we'll be following that closely. I think to kick things off, I think I want to, as usual, we'll start with kind of the macro environment since it's been really just dominating everything in the news. So I want to start off by kind of painting a picture here. So we've got the 30-year treasury at a 19-year high, the 10 years around, let's just say 4.5, and equities are starting to kind of feel a little bit of the brunt with the AI darlings starting to kind of sell off. Dollar still remaining pretty firm with DXY at 100. And crude, again, is getting that Hormuz headline bid. Underneath that is really kind of the macro story where we see inflation data continue to kind of harden against the animal spirits of the markets. We saw a 3-year high CPI yesterday, and we also got a hot PPI print this morning, along with I think Frankfurt, the ECB is hiking rates. So I think the question is what kind of regime are we in? And for that, I think Tomas, I'd like to kind of cue you up here. Help kind of outline what's going on in this environment. I think we're seeing energy still drive a majority of these inflation prints yesterday and today. And we've got a new chair who's coming in next week who really has I guess we assume to be rather dovish, but has really only made a lot of public remarks on the balance sheet and talks about shrinking that balance sheet than explicitly trying to cut rates in this environment. So, are we entering a 1970s kind of environment where we see, a new Fed chair coming in that will maybe look a lot like Arthur Burns, and we'll get kind of this supply-driven inflation prints going forward, or are we going to have, a Kevin Warsh that's going to be able to kind of do what he needs to do to kind of keep things in check?
It's really hard to answer because it's all really, in my opinion, driven by the ongoing conflict between the U.S. and Iran and the impact it's having on the supply chain and with crude movement. And so it's to me, it feels very binary in the sense that if tomorrow we came to some form of an agreement where crude was unperturbed in this movement through the Hormuz Strait and just around the Middle East and those production areas, then you could see a path where oil prices come back down meaningfully, and all the inflation problems that we're talking about pretty much go away, um, to a degree that I think the Fed and other central banks would feel comfortable painting a trajectory of easier money looking forward. But obviously the last 2 months have been a series of ups and downs when it came to, hey, we're days away from a signed resolution, and the next day it's a bombing campaign. So it feels very binary, but I think we surprisingly haven't reached a point in the supply chain itself, whether it's due to demand destruction or US exports picking up to record levels on crude. We haven't reached a level where the squeeze on oil prices reflect what you saw in the last oil shock decades ago, because the crude is still holding up pretty well given the conflict and the escalation we've seen. It's still around that kind of like $90, $95 a barrel price, and so it can change on a dime, I think is really the takeaway on my side. I think what you're going to be paying attention to during next week's FOMC is whether Kevin Warsh starts making any kind of quote unquote dramatic changes more along his line of the vision for the Fed. So, for example, rumors around whether they might include a dot plot in their projections. That's something that he's indicated he does not think is appropriate. And so I don't expect that we're going to get a rate cut, but we might start seeing the early innings of what operationally is going to change under his leadership.
Yeah, and I know we're going to be talking a lot about the Fed, perhaps even when we talk about what we're looking for the week ahead. But sticking with this inflation environment, I think energy drove, let's just say, around 60% of that CPI print to a 3-year high, and on the PPI, it actually I think drove a little bit more of that print. So we're seeing kind of what economists would traditionally consider one-off shocks, right? One-off kind of influences on inflation. My follow-up question to you is, we keep seeing one-off things happen in I think in this environment. Last year we had the one-off tariffs. This year we're getting, the one-off impacts of energy prices. How long can we go, for the audience, how long can we go down this road of one-offs until things really just start to cement themselves and inflation really starts to kind of spiral out of control again?
I mean, I think the one-offs are really driven more by geopolitical agendas that are taking place. Like you mentioned, the tariff decision was a geopolitical one. You have this issue with Iran now, another geopolitical one. Not really sure what other shoes there are left to drop, but I think a big part of why these situations are possible, ironically, is because of the growth coming from the AI wave and just the amount of capex and economic waves or positive outcomes that come from that. And so, in some ways, it almost feels like the administration is cashing a check off the back of this momentum from the economy, particularly on the AI side, because I think absent the kind of movement we've seen in markets or even economically with the capex spends, it'd be a very different picture, and it would be very politically difficult to be undertaking these kinds of campaigns. And so I definitely think the Trump administration, on their agenda of trying to promote growth, is also aggressively leveraging that to target geopolitical moves that offset some of that underlying growth that would otherwise take place.
And that underlying growth certainly has been, I think, surprising for most, including ourselves. We were in our outlooks often citing, labor market weakness as a key catalyst for clearing the path for the Fed to ultimately do rate cuts this year. And these last 3 NFP reports have just been completely above consensus and really hot. So I think that's when we were talking last week, we saw that market reaction from a surprise upside into the NFP numbers. I think for crypto, we're seeing the squeeze kind of tighten as we've seen 10-year yields kind of continue to grind higher. And I think if we want to, discuss kind of like what this means for FOMC predictions through 2026, I think we're still seeing that by December there's still a 20% increase, right, in a possible rate hike. That's what's currently being priced in. So, Mark, see you unmuted yourself. You not sure if you wanted to jump in and add some color.
Yeah, it's not just it's interesting too with the oil shock, because it's not just the Fed and the ECB we saw hike today, that we're seeing liquidity conditions all around the world getting a little bit tighter. We've got the Japanese 10-year at levels we haven't seen since 1998. We have the Japanese central bank meeting next week, and it looks like they're probably going to hike rates to 1%. And what we want to watch there is the guidance to see if there's a rate path even higher than that, maybe 1.5%, 2% over the next year or so, because we could start to see more of that yen carry trade unwind that started back in August of 2024. The Bank of England's holding, but if you look at the 10-year gilts, those spiked over 5%, which is the highest level since pre-GFC. So we have just pretty tight liquidity conditions everywhere that are really putting a damper on crypto. That's going to be a major headwind going forward.
Yeah, and I think that headwind is something that I think the markets, you could argue, in the crypto side have rightly priced this in. But if I look at the CME FedWatch tool, and I think I still see like a 20% probability of a rate hike here in the US and not a 50%, that tail to me seems like it's still relatively cheap if you're trying to maybe get in front of hedging it on the equity side or the other risky asset side, when you look at these other asset classes that are still relatively close to all-time highs. Crypto right now, at least given its sequence of path, is relatively discounted still. So I kind of want to open this up, or maybe ask Ish, how do you see kind of the disconnect of crypto markets currently in this environment versus where the equity space is? And I know that they're starting to kind of roll over a little bit with the AI trade unwinding, but it's still relatively strong performance year to date.
Sorry, can I jump in really quick? I just wanted to clarify. You're looking at the December Fed meeting for rate hike odds, is that right? Because I
Correct.
have
Yeah.
it at near 60-70%, I think.
Oh man,
70.
Did that jump up from yesterday? Or
No, it's because the whole curve shifted to the right, basically.
there we go.
Yeah, right now
So
it's
it is
around
starting to get priced in.
60% or north of 60% chance that we get a rate hike by year end is the odds.
Well, that's starting to get priced in rather quickly then, yes.
Yes.
Well, good call out there, Tomas. Thank you.
I'll just jump in. I definitely agree, Gabe, that crypto is very discounted compared to the rest of the markets where it stands today. I think it's an interesting question of what will it take for crypto to find a bottom? Will it take more rate cuts? Is a rate hike going to drive it further down? I think that's yet to be seen. I think there's a bit of a breakout, like divergence within the crypto sector. Different assets are behaving a bit differently. So something like Bitcoin, I think, is a bit more macro sensitive. But I think there's a lot more room to grow still.
Yeah, no, definitely. So yeah, I'm not sure. I'd be really curious to get your take. Obviously, you've given us a lot of sage wisdom in the past. So, what's your view, I guess, on the macro environment, and how do you see that, permeating through our, the business lines that you are so connected with every day?
Yeah, thanks, thanks, Gabe. It's great to be on and chat with you guys. Don't do it often enough. Apologies for that. But I'm sat here in London, and we talk about you were talking about one-off macro shocks, and in the UK, obviously not the bellwether of the global economy, but one of the G4, and we talked about gilt yields. You talk about the yield picture, gilt yields climbing above 5. It's the highest, I think, since 1998. Since fallen back a little, but we're still in that sort of zone of elevated, what would what would count as elevated rates, at least compared to the past 20 years. And the UK has been undergoing these series of one-off political macro shocks. There seems to be one every month. Today, past few days, there's been some civil unrest in Northern Ireland. So Keir Starmer's premiership looks increasingly shaky. Just had the resignation today of the UK Defence Secretary, because the UK is struggling to balance out spending commitments with fiscal picture, and rising rates doesn't help that. So, for me, it's that question of that you posed. When does a series of unfortunate, seemingly unlinked events become enough to embed itself structurally, such that we get a sort of stagflation scenario? And I think that is increasingly on people's minds as a possibility. It's a theme that has come on and off over the past sort of 5-6 years. It's certainly coming back at the moment, and how that will affect the crypto market is a really intriguing question. I don't have a crystal ball, but I get a sense that the news cycle has to turn positive for risk assets to enjoy any form of tailwind, whether that's an end to the conflict in the Middle East. That's probably first and foremost, and just greater political stability, geopolitical stability, because literally anything could happen. I think that's what a lot of investors think. Literally anything could happen, and so in that scenario, it's very hard to be positioned with conviction.
Yeah, and I think it's pretty clear it's a pretty clear path to see, all of the things that are going wrong and could continue to go wrong in markets, in the economy. And kind of ironically, last week we had the NFP report that blew expectations out of the water, and we saw the Nasdaq sell off 4%, I think, on the day. So good news is turning into bad news in that dynamic, and this is kind of like the market's telling you that we're not pricing. We weren't ready to price in a rate hiking cycle for the Fed. And one thing that I typically like to look at as far as a leading indicator for future private payrolls is kind of business surveys. So one of the business surveys that I like to follow is NFIB Hiring Intentions Index. So that's from the NFIB Optimism Index that we get on a monthly basis. And the May reading, seasonally adjusted, when you advance that 4 months, it actually plummeted. So we saw that leading strength coming out of that index, these past few months. But it's, looking at the May reading, which I guess is my leading barometer, is telling me that this employment picture that's currently being painted of resilience and robustness could have some cracks in it in the coming prints. So it's something to kind of keep an eye on. And I just only bring that up because of the fact that we've talked so much about kind of all these one-offs, all these things that keep happening and that keep repricing the Fed's ultimate 2026. Where are they going to be on their policy rate? And this is, I think, a picture where you could start to see some cracks, because if you start to see the labor market turn a little bit more sanguine, certainly that would, I think, pump the brakes on a rate hiking cycle. It'd be very hard for, I think, the committee to embark on something like that if that's the case. So before we kind of wrap up with the macro picture, I just want to open it up. Does anybody else want to jump in and share any other insights or things that they're looking at?
Yeah, I mean, with regards to crypto, I do think it's for a long time been waiting for excess liquidity to enter the system. And for as long as we haven't had that, we're just watching capital rotate through the different opportunities. I know we're going to get into the SpaceX IPO, but that's one area that I think is pulling away from crypto. And until we enter a more favorable, rate cutting cycle or regime, that might be what it takes to see crypto succeed alongside the broader market.
Yeah, that's a good point. Good point. And so the next topic that we wanted to jump into was something a little bit more crypto centric. So we're going to talk a little bit about Hype and Hyperliquid. We just recently published a blog post yesterday that it breaks down kind of a valuation framework for Hyperliquid. And Mark, I'm going to have you maybe outline that and some of the things that we found. But Hype currently is trading, I think, just under $60, or around that zone. It was at all-time highs last week. 2026 it's been just on a tear. I mean, it's the best performing large cap. We included it into our large cap and broad cap indices in our latest index reconstitution rebalance here that we did earlier this month. So it's now being included in kind of like the S&P 500 of crypto indices, which is super important. But I think it's still up, around 65, let's say 70% year to date. I think a lot of that has been driven on kind of its fundamental thesis, and with the fundamental thesis, it allows us in the kind of like the TradFi world to kind of break down those earnings, if you will, the revenues, and give some valuation metrics, which is something that I think is historically missing in crypto markets. So Mark, why don't you give the audience a overview of our valuation framework and kind of our paper?
Yeah. So first, I got to talk about Hyperliquid and the way that it generates revenue. It's pretty similar to a lot of TradFi venues where it takes a little bit of a cut. It has a take rate on every single trade. And over the last 12 months, that's translated to roughly $1 billion in top line revenue. And what Hyperliquid does is it takes that revenue and uses about 83% of it to buy back its own token and burn them. So if you think about that from an earnings standpoint, or earnings that go back to the token holders, you're looking at it operating at about an 83% margin. If we take a look at some of, say, our competitors like Coinbase, they operate at about a 19% margin. If you look at Robinhood, which is a pretty high margin business, they operate at about a 43% earnings margin. So Hyperliquid has the advantage because it doesn't have employees. It's got a team of 12 people. It can run at 80% margins, which you don't really see in the traditional markets. So if you look at what that translates to in terms of a multiple on its fully diluted value, it's currently trading at about 61 times its trailing earnings. Where if you look at Robinhood, that trades around 40, Coinbase trades around 40. And then if you take some of the other venues like the Intercontinental Exchange that owns the NYSE, or if you look at the CME, those trade around 20 times earnings. So our thesis, or the premise here is there's a real premium. One, because you can grow a lot faster as a crypto venue. It's a lot easier to get access. And then two, the other part of the premium comes from the fact that the margins are just so much higher. So if we think about Hyperliquid and how it can grow over the next year and with what's new. So right now they've launched a whole bunch of perps on both equity indices. So S&P's launched the 500 on there. XYZ has launched a NASDAQ perp on there. The oil perps were the real breakout during the Iran conflict when you couldn't trade on the CME on Saturdays. So when you combine all those TradFi markets that are growing, you're looking at probably about 50, 60, 70% annualized growth right now. So if we take that and apply around a 65 times earnings multiple like we're seeing on a forward basis, we're looking at a base case price target of around $106 a token on a forward 12-month basis. So there is significant, close to 100% upside on this thing, just in a base case. Now, you could see growth pick up a little bit faster with the launch of things like prediction markets and other things on the Hyper EVM. In that case, maybe you get a little more multiple expansion to maybe 75 times earnings, which is kind of what you would see in super high growth tech companies. Like think when NVIDIA was growing in 2023, 2024, you could see upside to about $170 in a bull case scenario over the next 12 months.
Yeah, it was really a fun exercise to kind of go through and compare Hyperliquid's fundamentals to some of these more publicly traded staple names that we all know and follow each quarter with their progress. And I think it's a really great case study for those that want to pay attention to the efficiencies of blockchain and how the scalability of of that technology can enable a business to really grow into a market cap in the tens of billions with a relatively small team, right? So if you think about constraints on a business, you have all sorts of constraints. You have human capital constraints, you have financial capital constraints, you have physical, actually brick and mortar constraints. If you operate like a restaurant, you can only fit so many people in your restaurant, each day. You have time constraints. With blockchains, it really unlocks all this like 24/7 operations through the algorithmic processes that allows you to really scale things out. And in the valuation methodologies that we looked at, we really assigned a premium to that. There should be a market premium to that optionality to have a scalable business model, and that's where I think Hyperliquid's really shining, and ultimately gives us a pretty good bullish case. Ish, I want to bring you in since I know you've looked at Hyperliquid a lot, and I guess I want to get your take first overall. Yeah, what do you think's really driving the price? I understand for any compliance reasons, we want to maybe stay away from explicitly talking about any securities that trade, including with your firm. But an overview of kind of like where hype is and the institutional adoption curve would probably be helpful too as well. But I want to bring you in here and get your take.
Yeah, definitely happy to share. I think to start, May was an insane month for Hyperliquid. Firstly, we had HIP4 launch, so that's prediction markets on Hyperliquid. And then coming from the institutional angle, we had 2 Hyperliquid ETFs launch in early May. We had a third one launch just this June, about a week ago. Also in May, we had the announcement from Coinbase, which took over the stablecoin liquidity on Hyperliquid. So that was just another huge boost to the Hyperliquid thesis. But as far as institutional adoption goes, it's been very strong. Hype ETFs have been one of the strongest performing spot crypto ETFs in terms of inflows since their inception. They've, in just a month, had, I believe, only 1 day of outflows and have gathered over 160 million in assets to date. That's a much stronger performance than a number of other spot crypto ETPs that we've seen in the past year or so. So that just really reflects strong institutional demand because, like you guys said, Hyperliquid is a thesis that a lot of investors can understand, particularly from the TradFi world. It makes sense. It's kind of an equity-like structure. And I do think that's one of the things driving its success largely is the buyback mechanism. I know a lot of people talk about, is revenue the next driver of, crypto fundamentals? And I do think that's true, but I think the reason Hyperliquid has been so successful is beyond just revenue. It is the buyback mechanism, because you look across crypto, there's other chains and projects that generate significant revenue. There's Solana, I think generates about $1 billion in annualized revenue. There's Pump Fund, of course, meme coin trading platform, hundreds of millions in revenue. But none of these other peers recycle the revenue back to the holders as well as Hyperliquid does. Mark said it well, as you guys outlined in your report. Hyperliquid's returning about 83 cents on the dollar to holders. That's more than these other crypto protocols. That's more than Coinbase, Robinhood, and other TradFi companies. So I think that's kind of the main driver of Hyperliquid success.
And yeah, just to follow along that, the launch of these ETFs have just been kind of a really fun to watch how much appetite there's been in those fund flows. It's really been, I think, an outlier. If we look at the Bitcoin funds, when they launched, they were, of course, historically demanded, and ETH was also up there. But these other relatively smaller cap tokens have had, I think, less kind of demand when they go as an individual token, whereas Hype, I think, is really kind of have stood its ground. And we actually recently rebalanced Hype into our flagship indices as a large cap constituent. So Sui, I wanted to bring you in and ask you, what does that mean when a token that did not even exist, I think, 18 months ago, is now an index level holding in something like an S&P 500 type benchmark?
Yeah, thanks for the bringing me in, Gabe, because it is not quite unprecedented, but it's a very rare occurrence that you get a token that's as young as Hype, not only did it enter the CF large cap, but it entered it as asset number 5, and entering at such a high level. The only assets that are bigger in the index, have a bigger weight in the index, so have a bigger market cap, a bigger free float market cap than Hype, are Bitcoin, Ether, XRP, and Solana. The sort of 4 majors. And it's been a long time since you've seen such a young token assume such a big market capitalization. Its liquidity keeps improving. As we mentioned, we've got spot ETFs in the US that have generated pretty significant inflow in what is still a difficult market for crypto assets. So that's the first thing, to really recognize the scale of this. Typically, when assets enter the large cap, they come in with a weight of sub 1%. So having a weight of 2.5% is really significant on entry. That's the first thing. I think the why has the performance been as strong? Then obviously the protocol itself, the Perpetual's decentralized exchange that runs on the Hyperliquid blockchain, has been very successful, as we've already talked about, generating significant revenues, significant margins, and those earnings are spent on acquiring and burning tokens, reducing the supply. And so very easy story for investors to understand. And I think that is probably the key, is that the story is easy to understand. You effectively, just watch the fee revenue, because that the cost base is low. So most of that will translate into earnings. And as Mark pointed out, a very high percentage of those dollar earnings are spent burning the token. It's very easy to understand. There's only one use case, and that is it's a perp dex. It's a decentralized exchange. It's there for trading perpetual futures. Now prediction markets, it's a trading venue. So again, a business model that's well understood. The scalability benefits of that are well understood from traditional market infrastructures. So when you put all that together, that's how you see the outperformance that we've seen.
I love that. Yeah, and so it came in at number 5 in the large cap, which is that is a pretty high ranking. I was just doing a little bit of back of the napkin research here on SpaceX, which is a topic that we're going to jump to later on. But SpaceX it's kind of a similar dynamic. If it would have been included into the S&P 500, it would have, I think, landed around like number 7 market cap spot. So Hype is kind of coming in, ironically, the same month as we get the SpaceX IPO, which would have, if it were to be allowed, which I guess it is being denied by the committee at Standard & Poor's. And I don't know, Sui, do you want to give us a lesson on index inclusion and why something like SpaceX ultimately could not have been included into the S&P 500 right away?
Yeah, so the S&P 500, they're not actually hard rules. They are, they're index rules, but they're interpreted by the committee, and ultimately the committee makes the decision. But the rules have always required a seasoning period. So stocks typically have to be listed for a year before they can enter the S&P 500. Now, there is a way that there are instances where you can have accelerated entry, but even accelerated entry is 180 days after listing. So that's the first piece. The second piece is 4 consecutive quarters of profitability, and that's a long-standing rule for the S&P 500. And S&P have decided to enforce those rules and not make an exception with SpaceX. Unlike a number of other index providers who made changes to their rules so that IPOs such as SpaceX's and potentially one or two others, would likely make it into their indices, on an accelerated basis. So it looks like we're not going to see SpaceX enter the S&P 500 probably for a year, or maybe even longer. So yeah, there is in terms of performance and how quickly. Well, SpaceX is quite an old company, of course. It's been around for a while, but it's only really captured the public imagination, I'd say, in the past 2 years. So in that sense, although it's older, there are parallels with the Hype example, and we at CF Benchmarks, we operate a similar set of rules to what S&P does in the equity space. So Hyperliquid on a pure market cap basis could potentially have entered the CF large cap at the previous rebalance and reconstitution date in March. Its market cap, just purely looking at its market cap, would have qualified it. But we require a minimum listing period on our constituent exchanges of for a whole cycle of the reconstitution and rebalance window, which is a 3-month window. And so on a market cap basis, it could have potentially entered earlier, but it was only in Q2, the second quarter. We don't follow calendar quarters on our rebalance schedule. The quarter just gone, the second quarter, that ended on May the 31st, that Hyperliquid actually qualified, because having been listed on CME/CF constituents exchanges for that full quarter, so that we could reliably observe all the liquidity requirements and turnover ratio requirements that crypto assets need to exhibit before they enter our benchmark index series. So in short, a couple of parallels there, but obviously in a more nascent, more dynamic asset class, our seasoning periods, if we call it that, are shorter. We observe over shorter periods than someone like S&P with the equity space.
Well, thanks, Zoe. Yeah, it's super helpful. And if you want to learn more, I guess, about these index round rules, we do publish everything. We're very transparent. And so go to our website, check it out. It is kind of fun to wonk out on some of these index frameworks that I think are often overlooked by practitioners. I think a lot of folks, if you were to ask them, how do benchmark providers create their indices? It's very hard to you probably find that most people wouldn't understand it, to be quite frank. So it's I think it's good to kind of do some homework sometimes and dig a little bit deeper. Before I turn the page on Hype completely, I think we should at least highlight some of the risks to our base case and to Hype token, and kind of take both sides of the argument here. And I think one of the more well-known risks is the supply overhang of token unlocks for the core developers, core contributors of the team. That's also been, I think, flagged by crypto influencer media types. That Arthur Hayes went on Twitter, I think, last week and said that he sold all of his Hype bag. I want to open this up to the floor if anybody wants to kind of maybe explain the supply overhang dynamic and the risk there. And maybe, Mark, why don't you kick things off, because we did kind of talk about this at the end of our blog post, and also highlighted some of the mitigants to that supply overhang risk as well.
Yeah. So when we look at Hyperliquid supply, if we look at just the rate of token unlocks, it's roughly 9 million tokens a month. Now, you do have to kind of offset that a little bit, because there's the token buyback mechanism that from the revenues. So the revenues they come in dollars, and then they buy back the tokens. So the higher the token price, the lower the number of tokens that you're buying back are. So as token price goes up, we see less of that supply be offset by the revenues. Now, the thing with the supply, the unlocks, is that the developers don't necessarily have to sell the tokens. This isn't like a lot of other layer ones where there was big VC involvement in the beginning. There actually isn't any. So there's nobody that's sitting there waiting to return capital to investors. So these guys will presumably hold or stake some of the tokens. There's also a staking mechanism with Hyperliquid where you could stake the tokens, which will kind of take some of that out of the effective free float supply if you think about it.
Ish, do you have any insights that you want to share as far as with these token unlocks and the supply overhang?
Yeah, I think it's definitely a potential risk. I know some of it is controlled by the ecosystem fund, I believe. I'm not sure the exact figure, but typically that's at least going to be in line with future ecosystem developments, and also Hyperliquid not having spawned from any VC backing also creates further alignment of whoever these insider token holders are. They're kind of aligned with the future growth of the Hyperliquid protocol. So it's less of an overhang than you oftentimes see with other crypto assets. But yeah, it still presents a risk. And then also another risk that I did want to highlight, something we've been getting a question about at Bitwise, is what's going to happen when other crypto exchanges or traditional finance venues get perpetual futures and 24/7 trading. Is that going to eat at Hyperliquid's market share? And where we stand on that is yes, in the past couple of weeks we've seen the CFTC approved first Bitcoin perpetual futures. I think Kalshi already hit $1 billion of volume within a week of launch of theirs, but that doesn't necessarily mean Hyperliquid is going to lose that market. We think some of the edge it still holds is particularly in the accessibility for deployers to launch new equity perpetual futures markets, new prediction markets, and commodities. That's something where they can go to market a lot faster than TradFi venues or more, frankly, regulated exchanges. And also the fact that Coinbase signed on to become the stablecoin manager on Hyperliquid and route fees back to the ecosystem is just another signal that Hyperliquid is remaining in the lead.
Yeah, it's super helpful. And do you know if they've explicitly named the U.S. as a target region on the roadmap? Now that we're starting to see, I think every day now I start to see news of other firms launching or planning to launch, perpetuals in the U.S.
Yeah, I don't know for sure, and I don't know what it would take either, but I would imagine it's a market they want to hit.
Yeah, no, but that competitive edge of being a quick mover certainly is something not to discount because of the fact that I think there is probably a lot less regulatory red tape to get a market going on Hyperliquid than perhaps getting markets going in these other more regulated venues that are onshore that are already existing right now. So kind of I think there's two sides of that coin is really what I want to say. And I think that's, we shouldn't discount that.
Yeah,
As we
the final risk that I think I want to just quickly touch on in Hyperliquid is it is centralized. There is a bit of a governance risk there. And an example that I like to use is in March of 2025. There's very few validators when there was the Jelly exploit. So they were able to actually vote to delist a market and to force close positions. So that is just something to think about if you're trading on the exchange, although that risk is likely to be mitigated over time as more validators join. We're now up to 30 plus validators. And back then there was only, I believe, 10 or so. So just something to watch out for.
definitely. Tomasa, I'm not sure if you wanted to jump in there. I saw you unmute yourself.
No, I think this is kind of the ironic thing when you have these protocols that substantially return most of their fees back to the holders via like the buyback burn mechanism is that when you reduce the value accrual scheme, you also ironically sometimes make it difficult to expand because like for example, accessing the US market is going to require some kind of licensing effort that doesn't cost zero money. And so it's always going to be like a trade-off. So it will be interesting to see how they try to play in that kind of expansion to the extent they end up doing so.
Yep, definitely. And I think we're getting close to the top of the hour. So I do want to hit the last point that we highlighted here before we close things out. And that is to cover the SpaceX IPO. We would be remiss, I think, not to talk about it. It's a pretty big deal. A lot of supply coming on the market. I think this is the biggest IPO ever. The last IPO that was, I guess you could call it the last biggest IPO ever was Aramco in 2019. It was extremely oversubscribed as well. It was retail heavy, and it popped on the debut and briefly, I think cleared 2 trillion, and then kind of broke its issue price, I think 3 months later when oil started to roll over. But I want to ask the group here: is SpaceX going to be kind of similar to that scene that we saw with Aramco? There's I think a lot more hopes and dreams being priced into its valuation. What I mean by that is if you look at, I think where it's pricing, it's a 94 times sales debut. Maybe let's talk about those hopes and dreams. Who wants to go first and kind of give the audience a picture of SpaceX's business and how we can get to justify these types of multiples at its public debut?
Yeah, I can kind of take a first crack at this here. So, looking at SpaceX's business, the thing that has me the most excited is their Starlink, their satellite internet business, that line of business. Just because that's kind of where I could see a lot of the value coming from longer term. If you have a subscription based internet model, you give people access that previously didn't have access. There's a case to be made that you can deliver pretty good internet to more people than previously had access. And then when you have a subscription, you can slowly sit there and kind of manipulate the price of that subscription and kind of crank that to get recurring revenue. And then that recurring revenue comes in and works out for you. In terms of just the amount of capital that this thing has sucked up or is looking to suck up, it's pretty ridiculous. I saw over $200 billion in interest for 75 billion in shares that they were selling. So it's multiple times oversubscribed. And then I saw a lot of brokers were kind of closing it off or tonight, I believe it is. So we'll see what kind of allocations people get. I've seen posts here on X of people talking about borrowing money to get into this thing. So there seems to be a lot of retail excitement around this.
Personally, yeah.
Yeah.
Personally, I just want to say that's a terrible idea. Just so we're clear, borrowing money to participate in an IPO like this is probably not the most prudent thing. So I just want to set that.
I think if you're looking at taking personal loans for this, I would probably steer clear. I would definitely steer clear of that. But yeah, that's kind of just to give you an idea of how much retail interest and how much kind of FOMO there is around this. So we'll see how it goes.
Yeah, and you mentioned Starlink in there. That's obviously a pretty established business that's growing rapidly. They did $11 billion in revenue, and they're growing, I think, north of 50%. So that's a really nice trajectory that you want to see with if you're trying to demand multiples like that. But I think one of the more frontier stories is the hopes of interstellar data centers, right? And maybe we could talk a little about that because if you look at the AI build out, AI is really becoming constrained by power, and Earth-based data centers are always going to be running into issues with electrical grids. You have regulatory red tape with permitting. You obviously have to transmit that energy across these grids. And there's all sorts of cooling bottlenecks that I think a lot of the environmentalists are pointing out as far as with the water that's required to do it. So when you look at SpaceX having this idea of an interstellar satellite data center, you have constant solar, you have no zoning rights up there in space, and you also get the cooling benefits of being out there. So there's potential for like massive scale if you can build this. And so I think SpaceX has a roadmap to get their first data center up in the next few years, according to the prospectus. And I think if you want to think about like a frontier story for the valuation narrative, that's orbital AI is really kind of it. Does anybody else want to jump in and share their 2 cents on SpaceX before we kind of wrap up and do the week ahead?
I just have a kind of like a broader high level thought. I really don't have a view one way or the other whether it's going to perform well either near term or for long term. Um, I think the interesting thing about like Elon's history with companies like Tesla, for example, is that he was able to take like some pretty capex heavy companies, like a auto manufacturer, or even like Solar City and on the solar side, and bring in like technology narratives and get like technology multiples for what are otherwise more industrial or manufacturing kind of businesses. Um, Something that no other manufacturer really benefited from on the valuation side. And what's interesting about this paradigm today is that he's sort of doing the same thing. Uh, you know, I don't think we can argue that like building a space company, AI company, et cetera, is not capital intensive. But the difference today is that all the other tech firms are also becoming industrialists themselves. And so I am intrigued about this like space data center concept. They obviously have a monopoly on on just bringing goods into space, cargo into space at a cost advantage. There are some like definitely physics related issues, even like the cooling part that's not trivial. Because yeah, I guess in theory, outside of the sun, it's cold in space, so to speak. But you have to radiate the heat. There's no conduction of heat like you do with water cooling solutions or air cooling solutions and stuff like that. So I think my point of view on this is that the the broader story is really around almost like I call it populist capitalism or populist liquidity, which is in a world where SpaceX is asking you for 75 billion and Google is asking you for 80 and Oracle is talking about 40 and Meta and Amazon are probably going to be looking to do tens of billions of dollars of equity raises over the coming years. Um, which do you choose? And I think it's like a very narrative strong kind of framework. People love investing with Elon, and that captures a lot of the attention. I made references earlier this week that if you look at US search trends on Google for the keyword SpaceX versus Bitcoin, there's been only 2 times in the last 6 years where it came anywhere close to Bitcoin or crossed um, the keyword Bitcoin. That was in May 2020 when they did their first manned space mission. SpaceX did that first manned space mission, and it's now 1 week, starting 1 week prior to their IPO to today, that SpaceX, the keyword is almost as visible or searched as Bitcoin. So I think that's kind of the framework that people need to start thinking about is you're in an environment where all these big stars are raising money and it's going to become a bit of an attention game rather than one around fundamentals and multiples because that's not going to get you the checks.
We've seen the way those narratives and the attention game that you're describing can really be successful in getting checks in the past few years. If you look at the VC market and the way people fundraise now, it's AI. So that's a good point. We're getting close to time. I think we should do our rapid fire round that we typically do each week. In this round ish, we just kind of share with the audience what we're most focused on for the week ahead or the 7 days ahead. I'll let Tomas go first since he's warmed up and ready to go, and I know he's got a lot that's on his mind, and then we can pass the ball around and end on time. How's that sound?
Sounds good to me. Yeah, I'll go quick on this one. So I think near term, next 7 days, next 2 weeks, call it. I care pretty deeply about what happens with the SpaceX IPO. So tomorrow's going to be a really important day. It's going to set the tone for equity performance in the short run, I believe. There's also going to be the question of whether there's a lot of dry powder that was raised up to this moment. So we're talking about these oversubscribed numbers. If they're true, then we're talking $200 billion likely around there of excess capital that can be redeployed or kept in cash. That will have some impact to different assets, I believe. And then next week's FOMC, I'm really looking forward to seeing whether Kevin Warsh is starting to strong arm some of his vision more on the operational side. Again, I don't think that he's going to come forward with a rate cut proposal, but I am interested to see if he's going to be starting to do these changes that he alluded to. It'll tell me whether he may be aggressive in the future if we get a resolution to the Iran conflict and a reduction in oil prices, that he might actually propose an easing path more quickly than people are pricing.
Thanks. And Mark, you want to kick things off next?
Yeah, so I'll give a couple of things that I'm looking for. As mentioned earlier, I'm actually watching what the Japanese central bank does. So I'm going to be not so much the rate decision, but to see if there is really a rate path significantly higher, to see if they continue to try to fight inflation over there. The other thing that I'm going to be watching pretty closely is the Bitcoin ETF flows over the next week. We have a lot of that dry powder, but we've also seen that equity outperformance. So for those advisors that are allocated to it, Bitcoin's down 50%. Equities are only a few percent off all-time highs. If you're going to rebalance, you're getting towards the end of Q2, quarterly rebalance time. Now's about the time you'll do it. So we'll see if some bids start to hit on IBIT and some of the larger Bitcoin ETFs.
I'll go quickly, and then I'll let our guests here wrap it up. For next week, I think the Clarity Act, it really is it's top of mind for me. We saw how it cleared the Senate Banking Committee 15-9 last month, May 14th, and sitting on the Senate calendar. But it's pretty it's going up against a lot of, I think, scarce time on the floor right now before we get to the August recess, and that July 4th target the administration wants is certainly slipping away if we don't move forward with it soon. As Tomas said, all eyes are going to be on the Fed next week. What kind of changes are we going to see from a new Fed chair? It's really hard to speculate on that, especially with a pick like Kevin Warsh. I just feel like we could expect all sorts of surprises as he's trying to kind of make his mark on the institution. Lastly, a fun one for me will be to kind of see how SpaceX prices over the weekend. So we've seen how the RWA tokenized stock movement is just continuing to pick up steam, and at Kraken they've got the SpaceX X stock token. So when the traditional markets stop trading on Friday, we're going to see names like SpaceX continue to trade over the weekend. So I'm going to be following the price action for SpaceX over Saturday and Sunday as well, and see how sentiment goes. Barring no further geopolitical shocks, which seem to just be popping up on my iPhone's notification center every day now. So with that, that's my take. Ish, why don't you give us your week ahead?
Of course, happy to close this out. I as well will be paying close attention to the SpaceX IPO. I think the market is probably a little bit ahead of itself regarding expectations and pulling forward the valuation to today. And I think there's a lot of capital to potentially go around that's tied up in the SpaceX story right now. So I'll be curious to see how that plays out on day one following this weekend. And then more on the crypto side, something I'll be continuing to monitor is some of the more idiosyncratic names that have broken out recently, like Hyperliquid, as we've talked about, but also the privacy narrative with Zcash and Near and Toncoin. I think so far they've been an interesting signal as to where the crypto cycle will be going from here, and rather what type of cycle it's going to be, and continuing to pay attention to whether or not these unique stories are enough to drive the next leg for the crypto market.
Excellent. Thank you so much. And thank you all for participating in another live session with us. It's always fun to get together and talk markets. As always, trade safe, do your own research, and go Knicks. Yeah, we'll see you next week. Thank you.